This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in our first session together on income tax here in Chapter 2, we saw how it was we put together the first part, and the main part, to be fair, of the income tax computation, whereby we'd list out each of the sources of taxable income, listing them down through earned and then unearned income, and analysing, critically important for the exercise we're about to do now, analysing those sources of income as a bottom line taxable income figure of firstly non-savings income, followed by savings income, followed by dividend income. If any of that you're uncertain of, go back, look at that first part, that first session of ours before again proceeding with this one. All right, so having got the analysed figures of taxable income, what we now need to do is to tax that taxable income. And the order in which we tax it, again, we should know. At the end of last session, we said we will firstly tax our figure of non-savings taxable income, followed by savings taxable income, followed, if of course relevant, by dividend taxable income. And the reason why we have to keep these separate and do them in that order is that there are different tax rates that are applicable to the different figures of and different types of taxable income. If you haven't already, make sure you've got a copy of at least the first page of your rates and allowances tables from, indeed, the introduction to this particular set of notes here, because we're going to be using those figures extensively through this particular session and indeed beyond into future sessions. Right, the first figure of income that needs to be taxed is our non-savings income. Now we know what it is. Your earned income, be it trading profit or more likely employment income for most taxpayers anyway, and also, if you're lucky, some property income that you might have as well. And this non-savings income uses any of three possible rates. They go by the names of basic rate, higher rate, and additional rate tax. And based on the amount of taxable non-savings income, these rates are 20% for basic rate, and that will assess the first up to £34,500. 34,500 there, that is the basic rate band limit. So up to that level, it's a 20% basic rate liability. Not too bad a rate of tax, we might think there. But of course, then things get rather worse for the taxpayer. As soon as we go above 34,500, oops, I'm just seeing there that says 33, that's last year's. That should be 34,500 there. When we go above 34,000 and then all the way up to £150,000, we're talking about higher rate tax. And that is 40% there. Now that is doubling the tax rate, as you can see. Now again, that's a much bigger band before you get to the additional rate at 45%. So a small increase over and above higher rate, obviously 5% there, but at least not another doubling of the tax rate. And that's on any taxable income in excess of £150,000 worth of taxable income. Now we just said what non-savings income is made up of. The property income, the employment income. We'll be looking for each of those at the employment income received, less any allowable deductions therefrom. The property income received, less any allowable deductions therefrom. And the property income we sort out in Chapter 3, and the employment income in a rather extensive chapter, Chapter 9. But when it comes to trading profit, when we're dealing with the self-employed, the unincorporated trader, then there's rather more chapters, as we said in our previous session, some 5 chapters in total, just dealing with how we're going to assess the profits of the unincorporated trader, and of course how we were going to give relief for any losses sustained by that trader. Now more of that later. So far as this chapter is concerned, you will be given any figure of trading profit to be assessed for the tax year. Most of the time, we're going to be using employment income and property income in these examples, however. But a lot more to look at, as you can see, on trading profits there. So, we've got our basic rate band going up to a limit of £34,500, and then from 34,500 upwards to 150,000 at higher rate, and above the higher rate band limit of 150, then we've got our additional rate band of 45% there. Simple example to begin with. Example 1. Mr. Smith, been working for many years, received a salary of £50,850. Not at all a contrived figure, as we will see, per annum in 2018-19 tax year. And they've also given us, they do not always do this in exam questions, tell us the amount of pay as you earn, PAYE, income tax deducted at source by the employer on behalf of HMRC. And that amount of income tax deducted under PAYE was £8,000. And very simple, it's got no other sources of taxable income. So the only income that the taxpayer has is the non-savings. So do we need the full pro forma income tax computation? No, we don't. All we know is that we've got this employment income, our salary, it's non-savings, and it's £50,850. You can do a total column in the suggested solutions to get you just used to the proper format. We've done the total column. But if this was an objective testing question, here to calculate the income tax payable by Mr. Smith for 18-19, we don't need that. There's one source of income, only one set of tax rates. These here are going to be applied. So all your total is non-savings. Right. Do we need then to show a total income figure and a separate net income figure? No, there's no deductions from total income. So that salary is also your net income as well as your total income there. Now, away from net income, if you look at your pro forma, if needs be, we know that we deduct the personal allowance. There is only one type of income here, one source of income to deduct it from. More than enough to absorb it. And there's the contrived figure, £11,850 there. That should make the calculations rather easier. So that brings us down to a taxable income figure of, well, you work it out, take the 11,850 from 50,850, and I think that's £39,000 of taxable income, all of which is non-savings. If there were other sources, savings and dividend income, it's still this bit that would be taxed first of all. What rates do we have? Up to £34,500, we have got basic rate. Therefore, 34,500 at 20% equals whatever that equals there. We are taxing in total 39. So we move out of the basic rate band and up into the higher rate band. Now we're taxing in total 39,000, of which through basic rate we've assessed 34,500. So what does that leave still to be assessed? £4,500. That is now in the higher rate band, so that is taxed at 40%. And we work that figure out. Now, once you've calculated those two figures of tax, you can do that with your own calculators there. That figure that you get is not what they've asked for, the tax payable. What's that figure that you get there? The combination of basic and higher rate tax on this source of income. That, I hope you remember, is your income tax liability. And to work from income tax liability to income tax payable, we then have to deduct, and it's going to be given to you if this is required, the PAYE figure. And the PAYE, the income tax deducted at source, was £8,000. So from your income tax liability, deduct the PAYE of 8,000 to derive any income tax payable. If the PAYE happened to be bigger than the income tax liability, then instead of having income tax payable, you would have income tax repayable. Yeah, they would repay. They don't sit on it there. It would be repayable in relation to the tax paid for the tax year. So income tax payable, very, very seldomly, of course, income tax repayable. So what I'd like you to do, therefore, is to finish that exercise off for me. Check it out with the answer in the back. there's way more information than ever you'd put into your answer doing this as you would be for a 2-mark objective testing question in the exam. But again, just to get you used to the structure of this computation, because when we come to all of the different sources of income being involved on the computation, it is important to know how to prepare it and what the constituent components are. Again, where you may well see this is not just for 2 marks, but for anything up to 15 marks in terms of that section C question guaranteed on income tax. So make sure you're happy with the structure. Okay, pause this therefore now, do your answer, check it out with the answer, and then come back. After that, of course, we'll start to thicken the plot a little bit by bringing in next savings income, and thereafter, once we practice that, of course, thoroughly, then dividend income. And those, well, the savings interest income, if you'll pardon the pun, is going to be a lot more interesting than what we've just done there. So pause now and join me when you've checked out and you're fully happy with the answer to example 1. Okay, well, hopefully no problems there. And as you see here in the answers, which just you've reviewed through, I've put in the full detail to get you used to the structure of these computations, to build them, because we're not just going to be dealing with non-savings income. Not even in the exam question there. We're going to see 2 or 3 different types of the non-savings, the savings and the dividend income there. But just to get used to that structure, we've got the non-savings, we've got the total. If you're doing an OT question, you're not doing the full computation as in a section C question, then that's all you need. Take away the personal allowance, get your taxable income, as we knew, 39,000. That is more than 34,500, so only the first 34,500 of it is assessed at the basic rate, which for non-savings income is 20%, and that, all being well, £6,900. But that's only 34.5 out of 39. That leaves another 4,500 that is now up into the rather more highly taxed and hence higher rate, as it's known, of tax, 40% band. That, all being well, is 1,800. Again, on these, by the way, do check through, just in case. There's a lot of things to update here from one year to another, and it's only me doing it. So if I have made any numerical errors, there's the Ask the Tutor section, of course, on the OT website, our OpenTuition website. Just drop me a little line and I'll check it out and amend it if necessary. Grateful for any feedback you can give me on that, because obviously what we want to do, all of us, is to make sure we've got the best set of notes for everyone concerned. So yeah, if you see anything that you think might be wrong, drop me a line on Ask the Tutor and I'll sort it out for you. Okay, coming back to, therefore, our calculations now. We get a tax liability, which hopefully here is £8,700. But they ask not for tax liability, they ask for income tax payable. So we take away the given, as it always will be if it's necessary to be used, figure of PAYE, and that gives us bottom line tax payable of £700. Now, as I say, here in these examples, that's very basic. You are going to see in an exam question, I say, something more challenging, or the word I use, of course, interesting there. And that, again, to lead us in with that perm, takes us to savings income. So let's go back to our notes now and continue with our study of savings income. So savings income, we know what it is. It's interest income. The only type of interest income we'll see in our exam is the stuff that is received gross. That means without any deduction of tax at source. Don't worry about the stuff that's received net. It's not in your syllabus. So it will be a gross figure given to you in the exam question, and that's going to include bank interest. We mentioned, of course, on our pro forma computation in our first session together, building society interest. It doesn't matter that you don't know what they are, but basically, as we said, a financial institution that came into existence mostly for, and although they're more varied these days, still the main work is basically lending money to individuals for the purchase of property. That's building society in terms of properties there. Government security interest, corporate bonds there. Again, sometimes referred to as qualifying corporate bonds, a term that you'll see in CGT, but that awaits us in Chapter 12. That's a long way away yet, so I'll remind you then. Also, of course, in any exam question, and it's a usual involvement, watch out for the exempt sources of interest. So in a little 2-mark exercise, they list out the different sources of income relevant for us, the 2018-19 tax year. You get a figure of building society or bank deposit interest. Those are all taxable and will be included within your income tax computation. But they also throw in, to see whether you, of course, deal with it correctly, a source of exempt income. Now, we dealt with those at the end of the previous session, so you should already know what they are. If you don't, you need to go back and make sure that you have learnt it. You may recall, I hope you do, that we might have had interest from national savings and investments, and then be careful about the next word, certificates. Interest from NS&I, National Savings and Investment Certificates. Those are exempt there, so we leave them off the computation. If you're dealing with a section C, a written question, and you have sources of exempt income, put a note on your answer to say why it is that a particular source of income has been left out of the computation, stating that it is exempt. For example, the interest on the National Savings and Investment Certificate, their interest income received. Or indeed any interest from an ISA, an individual savings account. If in section C you have exempt sources of income listed, you have to prepare the income tax computation, state why it is that you've left those out of the computation, specifically stating they're exempt. If it's a 2-mark objective testing question, of course, probably in section A that you're talking about here, then you're not saying anything other than leaving it out and not including it in your figure of taxable income, and hopefully going on to correctly compute either just the correct figure of taxable income, or the tax liability, or the tax payable. Okay. Basis of assessment, as we know, is the interest received in the tax year. Most sources now of taxable income of an individual taxpayer in the UK are assessed on a most sensible basis, the amounts received. But as we go through each individual source, through each chapter, we'll again stress the specific basis of assessment that is applicable. So taxable interest received is included in our savings income column on our computation. Any deductions in our income tax computation, most likely the personal allowance, but if they exist, they will be deducted prior to the personal allowance. Various reliefs, that is again usually loss reliefs that we're talking about, or certain loan interest payments. We'll be discussing those again later in our lectures. So any deductions, be they qualifying loan interest, be they any trading loss reliefs that you might have, any such figures, they are deducted where from? Firstly from non-savings income, followed by savings income, that's the one we're now dealing with, and only eventually, if necessary, through to dividend income. Hence again, as we know, the order in which we listed out those sources of taxable income. Now, non-savings income, as we've already stated, that is treated as the first slice of taxable income to be taxed, followed by savings income, and finally dividend income. Hence the order in which we run those columns. Get used to it. The total of this tax is the tax liability, and if we have any PAYE given and they ask for tax payable, then we deduct it from the tax liability to arrive at that income tax payable figure. The tax rates that we use. Now, to begin with, it looks nice and easy because these are the same rates that we used for non-savings. We will discover that the usual rates that we apply, we will see, again, if applicable, here, the taxable savings followed by the savings in your rate band, if available, and thereafter, so all this bit you don't yet know, but thereafter, the normal rates. So once we've gone through the tricky stuff found again in these notes here, we're going to revert back to the same rates as we use for non-savings. But before we get there, there's a lot of interesting stuff to look at. So remind yourself, what were the non-savings rates? Up to 34.5, basic rate 20, correct number this time, from 35,500 upwards there, over 34,500, up to 150, higher rate, 40%, before you get up to 45% additional rate. Now then, the problem with savings income, it says here, may now be quite complicated. Well, that's a bit of a subjective term, isn't it? But there's been a few changes in recent years, not that you need to know when they occurred, they're all applicable now, that have made what used to be historically a fairly straightforward and simple calculation into, we can go using the pun, but a more interesting one when it comes to dealing with savings income. Now, actually, the fact that it's complicated is not such good news for you, but it's very good news for the taxpayer, because what we have is either of two 0% or nil rate bands that may apply to certain parts of your taxable savings income. So we've got to see how these various rate bands apply. So we'll need to concentrate on this. So the taxation of savings income in an exam question made more interesting due more recently to the introduction of a nil rate band of £1,000 for basic rate taxpayers. Remember, basic rate taxpayers, taxable income does not exceed £34,500, the basic rate band limit, but only £500 for higher rate taxpayers. So HMRC, definitely not me, HMRC are more generous, which is a good thing, to basic rate taxpayers. Those with less income get a bigger nil rate band there in relation to their savings income. It reduces to just £500 for higher rate taxpayers, and you might guess it the way in which we're going. Additional rate taxpayers, they don't benefit at all. There is no nil rate band applicable in relation to additional rate taxpayers. Now remember, what makes you one of those? Basic rate, as we said, your taxable income does not exceed £34,500. Higher rate, it exceeds £34,500 but does not exceed £150,000. Additional rate, it exceeds £150,000. When we do our tax calculation, then that first £1,000 if you're a basic rate taxpayer, £500 if you're a higher rate taxpayer, that savings income nil rate band counts towards the basic rate and the higher rate thresholds. So when we go through our non-savings then to savings, we list out in our tax calculation £1,000 at zero or £500 at zero at nil rate. It counts towards that cumulative total of £34,500, or eventually indeed up to that cumulative total of £150,000. We don't just ignore it. This is not an exemption. This is a rate of taxation. You apply it, as we'll see in a few minutes' time, in your tax calculations there. Now, what makes this, again, more challenging is that this, as this note says, supplements a 0% starting rate of tax that we've had for many, many years. It predates the introduction of this savings income nil rate band. A 0% starting rate of tax that is, however, only available if the taxable figure of savings income, so again, remember your pro forma computation down to taxable income, non-savings, savings, if that taxable figure of savings income there, again, falls within the first £5,000 of total taxable income. So we know at the bottom of the computation, we have computed up to 4 figures of taxable income, a total figure, if we need it. Didn't need it in the previous example 1, but a total figure, and up to 3 analysis columns, non-savings, savings and dividend. And we tax our taxable income in that order. So it's firstly non-savings income. Now, as we said a moment ago, Savings income is taxed using the same rates as non-savings income listed above, but the starting rate of tax of 0% will apply to a maximum of, we said it was 5,000, maximum 5,000 of taxable savings income, where any part of the taxable savings income falls within the first £5,000 of the total taxable income. That may sound slightly more difficult than it is. So best here that we illustrate with some little examples. Pardon me. Just to show how these various nil rate and 0% starting rate bands will apply. Just get to the end of the note before we do that. If therefore the first £5,000 of taxable income consists of non-savings income, then the 0% rate will not apply. So if therefore we have got at least £5,000 of taxable non-savings income, then there is going to be no use of the starting rate band. So only if the taxable non-savings income does not exceed 5,000 does, as we'll see in a moment, the starting rate band come into play. If applicable, the starting rate is applied first to taxable savings income, so you deal with it first of all. Is it applicable? Is it not applicable? If it is applicable, how much of the 5,000 max starting rate band of 0% is available? If, as we've said, as may very well be the case in many situations in real life, let alone in the exam, if your taxable non-savings income exceeds £5,000, then no part of your taxable savings income can possibly fall within the first 5,000 of your total taxable income. So the starting rate band is irrelevant. But it would be applied first, followed by the savings income nil rate band. And that is available, of course, simply on a basis of, are you a basic rate taxpayer? So you get £1,000. Are you a high rate taxpayer? You get 500. Additional rate, you get nothing at all. Right. As I said, to understand this, we need to do some simple examples. So I've set up here our usual 3 columns, of course, that we have. Non-savings, savings, total. Again, we could have, of course, dividend income and make it a 4th column there. We'll come to that later. Right, let's put some numbers in here. Now then, if we had a salary figure, what type of income is salary? Where would it go? Salary, of course, is non-savings. Let's assume that's £20,000. Anything that goes in analysis column, if we need to show a total column, we will here, goes in the total column as well. And then we've got some interest income, maybe bank deposit. Let me abbreviate there to BDI, bank deposit interest. What type of income is it? That, of course, is savings income. 10,000 and 10,000 into the total. That would give us total income. 20, 10, and the total of that total income, of course, 30,000. We'd look to see here there aren't any deductions from total income in deriving net income. So here total income and net income are the same. But that, of course, is not the taxable income, because what do we deduct from net income to derive the taxable income? And that, of course, is your personal allowance. Your personal allowance, hopefully you'll remember it, but it's on your rates and allowances page, is £11,850. Where do we apply it first? Against non-savings. Here is your non-savings income column. £11,850 comes away. All of the personal allowance is used against the non-savings income. So there's no excess personal allowance to go then against savings income. The 11,850, of course, deducted from your total. And what do we get? In terms now of our taxable income figure, what have we got? 11 would be 90, so that's 18,150, and that therefore is going to, oh, did I say 18,000? There's my mental arithmetic. That will be 8,150. This is 10,000. I know there's an 18 somewhere. Our total would be £18,150. So we've established our figures of taxable income split here by the relevant analysis of non-savings and then savings income. We now need to calculate our tax figure. All we'll do in these calculations is to bother about tax liability. So what income is taxed first of all? That, of course, is your non-savings income. How much do we have? 8,150. What is the basic rate band limit for our non-savings income? 34,500. So all of that 8,150 will be taxed at 20%, our basic rate band. What that shows us, of course, there is that non-savings taxable income, as I stressed when going through the note, there 8,150 exceeds £5,000. The 0% starting rate band that may be available for savings income is only available if any part of your taxable savings income, i.e. your 10,000, falls within the first £5,000 of your total taxable income of 18,150 to be taxed. Does it? No, it doesn't. What you've got, 8,150 exceeds 5,000, so the 0% starting rate band on your savings income is not available. That figure there would have to be less than £5,000 for any 0% starting rate band to be available. It's not available here. So we've taxed the non-savings, we now move through to our savings income. Right, what level of taxpayer are we? We've got £18,150 in total of taxable income. Does that exceed your basic rate band limit of 34,500? Of course it doesn't. So in which case, you're a basic rate taxpayer. Right. If you're a basic rate taxpayer, then you benefit from the savings income nil rate band. Now, I know it might get confused by these terms, but we had the 0% starting rate band not applicable here because that figure was at least £5,000. But because this figure, the total taxable income, means that our taxpayer is just a basic rate taxpayer, the figure does not exceed £34,500, the basic rate band limit. As a basic rate taxpayer, what does our hero, our taxpayer, enjoy on their savings income? A £1,000 nil rate band. So the first 1,000 is 0%. So notice we don't ignore that 0%. We don't just say, oh, let's leave 1,000 out and we've only got 9,000. It counts within this overall total of the income that is chargeable to tax. It's included, therefore, it counts towards, not that we're going to get there on this one, but it counts towards your basic rate band limit. So that's sorted out the first 1,000 of the £10,000 amount of taxable savings income. The remaining 9,000 of savings income still to be taxed very obviously falls within the basic rate band. 18,150, we are within the basic rate band. And therefore we apply, after we've dealt with starting rate, not applicable here, savings income, nil rate band, is applicable here, basic rate taxpayer, £1,000. Had we been a higher rate taxpayer, would have been £500 there. What's left over? out of the 10,000 total, £9,000, and that therefore will be taxed at your normal basic rate of 20%. You'd work those figures out. I think I know that one. That will be nil. You work those figures out and you get your tax liability. Now again, you can use a calculator perfectly well. The point is the process here. Do you know, out of that £18,150 worth in total of taxable income, how it is going to be taxed? Firstly, non-savings, then savings. If relevant, it will be later, then dividend income. Tax the non-savings income first of all. How much do we have? 8,150. Less than 34.5, therefore all taxed at 20%. But 8,150 is more than 5,000. There is savings income, here 10,000, but it means that none of that savings income will benefit from the 0% starting rate band. As is a basic rate taxpayer, or as he or she is a basic rate taxpayer here, we do benefit from the savings income nil rate band, £1,000 at 0%. It leaves 9,000 still within the basic rate band of savings income to be taxed, and that is at 20%. Put it through your calculator, get your tax liability, job done. Now that again could very easily be a little 2-mark Section A objective testing question to sort out that figure of tax liability there. Right, now in that example there was no application of the 0% starting rate band. Let's see whether that changes in this example. Again, we'll stick with non-savings, savings, and then total. We had in the previous one salary, employment income, and then, of course, our savings, our interest income. There's no need for me to list those out again and give you the total. We'll just go straight to a net income figure, i.e. before deducting the personal allowance, that would then, as you know, at least I hope you know, bring you down to taxable income figures there. And let's assume our non-savings, our salary, this time isn't 20,000, but we've got net income of £15,000. We'll stick with the savings income of £10,000 and total therefore 25,000. Personal allowance, 11,850, of course, is available to us. Non-savings income is bigger than 11,850, so all of the personal allowance is allocated to your non-savings income. It will, of course, also be deducted from your total. Your non-savings income, take 11,850 from 15. I think there, not that I was too good on this on the previous example, but I think that will be 3,150. 10 there, 11,850 from 25. Just do a quick cross-check on this one. And that, yeah, is 13,150, the sum total of the 3,150 and the 10. Now then, the process. Non-savings taxable income to be taxed first. Is it less than £34,500? Yes, it is. It is only £3,150, and that therefore means it will be taxed at 20%. It's all very obviously within the basic rate band. But then we've got savings income coming in. Some £10,000 of taxable savings income. Does any this time of the 0% starting rate band apply? What was the rule? The rule was if any part of this taxable savings income is within the first £5,000 of your total taxable income, then it will benefit from the 0% starting rate. As you can see, our taxable income so far is only £3,150. Therefore, some of that 5,000 starting rate is available. Now then, how much? We've got 3,150 of the first £5,000 of taxable income being non-savings. Therefore, of the first £5,000 of taxable income, just £1,850 of that will be deemed to be out of this total £10,000 of taxable savings income. So that 1,850 will benefit from the starting rate. Now, if this is a written question, you can then put a little note there to that effect as to why it is at 0%, because it's benefiting from that 0% starting rate. That's taxed just 1,850 out of 10,000. Again, and very obviously based on that total, the taxpayer is a basic rate taxpayer. So in terms of their savings income, again, as in the previous question example, there is a savings income nil rate band available of £1,000, which again is 0%. You could have another note there, note 2, obviously saying that the taxpayer is a basic rate taxpayer and therefore benefits from £1,000 savings income nil rate band. Of course, if this is an objective testing question, you're not doing any notes, you're just doing the calculations as quickly and as carefully as you possibly can. Well, we've got a tax in total £10,000 of taxable savings income. What have we calculated so far? 1,850 plus £1,000. So we've calculated tax at 0% for two different reasons on a total of £2,850 out of the total of 10,000. So what does that leave? 2,850, there's your 2,850 already taxed. Away from 10,000, well, that's going to be, what, £7,150. And that, again, we know we're only a basic rate taxpayer, so we follow the same then tax rates as for non-savings, and that is in the basic rate band, so it's taxed at 20%. We do our calculations, obviously each of these is nil. We get our 3,150 at 20, 7,150 at 20, get your tax liability figure as a result. So that process is what you need to know. Okay, take a moment at this point just to go back through those examples and make sure that you're happy with them before we go any further there. Okay, well, to finish off this particular section of this chapter, set up another little example here just for us to have a go at to make certain that, again, we're happy with the way in which we tax not just the simple non-savings, but the more challenging, the more interesting savings income there, and the application of, firstly, if applicable, the 0% starting rate band, thereafter, the savings income nil rate band. If applicable, it is applicable at one level or another if you are either basic rate or higher rate taxpayer. Now here in this particular example, again, with income, net income of 20,000 before deducting the personal allowance, clearly you're a basic rate taxpayer. So we've got to work out, do we have any starting rate band? Do we have, yes we do, a savings income nil rate band, and then any excess above the figure of savings income that covers, here out of your total of £10,000 to begin with at least. But if any part of that taxable income there goes outside of the 0% starting rate, the 0% savings income nil rate band, then in the basic rate band, it's your normal non-savings rate of 20%. This time, of course, what we've done is I've given the individual a salary, therefore non-savings income of only 10,000. Now, look at what now happens. The personal allowance is 11,850. But that's more than the salary figure of 10,000, that non-savings net income. So we'll use just £10,000 of the personal allowance there, which means none of our non-savings income is taxable. It's nil taxable non-savings income. But of course we haven't yet used up all of the personal allowance. We've used 10,000 out of 11,850. So that still leaves a further £1,850 to be allocated against the savings income. That brings us down to a taxable savings income, mental arithmetic again, of I think 8,150. We've got 11,850 total of personal allowance deducted, which I think indeed is 8,150. But now, of course, we have no taxable non-savings income. The only taxable income we have is the taxable savings income of 8,150. So what do we look to apply first? The 0% starting rate there. How much starting rate band is available? Well, have we had any part of the first £5,000 of taxable income yet taxed in terms of non-savings? No, there is no non-savings taxable income. So the first 5,000 of taxable income is all a part of that savings income. So here our savings income will be taxed. To begin with, the starting rate, 5,000 at 0%. Again, if necessary, a note to tell the examiner in a Section C question that that is starting rate band being applied on savings income. We are, of course, a basic rate taxpayer, so then we get the 1,000 savings income nil rate band at 0%. A note, if necessary, saying, as a basic rate taxpayer, qualifies for the £1,000 level of savings income nil rate band. What does that leave, therefore? Out of the 8,150 in total, we've already dealt with 6,000 of that, most of it at a 0% rate. This is looking very good, isn't it, not for the taxpayer? And that leaves just £2,150 to make up your total of 8,150 there to be taxed. It's all in your basic rate band, and that therefore is 20%. That then will be, again, your tax liability figure. Okay, again, look back through these examples when you're happy with them. Then what I'd like you to do between now and the next session together, back in our notes, we have, well, in fact, examples 2 through to 5 for you to have a go at. Don't worry about reading through, though if you want to before next session you can, on the taxability of dividend income. In examples 2 through to example 5, only as far as example 5 there, example 6 includes dividend income. Wait till I've dealt with that with you next time. For examples 2 to 5, make sure that you're happy, you're again okay with the working of a tax liability or tax payable, if required, in terms of a mix of non-savings and savings income there. Okay, do that next time. We'll then deal with the last bit of the taxable income that we have, the dividend income, where we'll discover that it too benefits from a dividend income nil rate band. How that works, we'll see next time.